Have you ever considered investing in the stock market? Well, today we are going to the book The Intelligent Investor by Benjamin Graham. Warren Buffett said this is the best book ever written about investing. Buffett read this book when he was 19, went to Columbia University, and Benjamin became his teacher. So when the richest person on the planet says that is a great book to read, I think it is worth investing your time in the book. First, you need to understand what investing really is. For starters, all you need to know is that there are supposed to be three major investments called asset classes, and they are stocks, bonds, and cash. A stock is only ownership in a company, and there are two ways to make or lose money in the stock market. You see, when you own a stock, you actually own one part of a company, and as the value of that company goes up, so does the stock price. And if the value of that company goes down, so does the stock price. These ups and downs determine the amount of profit or loss. The second way to make money is when the company shares the annual profits with you in the form of dividend. Stock prices can go up and down dramatically for all kinds of reasons. As a result, stocks are the riskiest type of investments in your plan. But there is a way to invest in the market without the risk of lost everything. Intelligent investing. There is plenty of money to be made through investments, but there is also much to lose. Financial history is full of stories of investors like Warren Buffett, who by investing in the right companies earned vast amounts of money in return, and there were just many bad luck stories, if not more, that people making the wrong bet end up losing everything. Three principles apply to all intelligent investors. First, intelligent investors analyze long-term growth and trading fundamentals companies they consider investing in before buying any stock. The long-term value of a stock is not desirable. Instead, it is directly dependent on how well the company performs behind the scene. So be sure to analyze the company's financial structure, the quality of its management, and whether it pays steady dividends. Intelligent investors analyze to ensure safe and stable returns. This is very different from speculating, where investors focus on short-term gains they made by market fluctuations. Speculating is therefore very dangerous, simply because no one can predict the future. For example, a speculator might hear rumors that Apple is going to release a popular new product soon, and then be motivated to buy more Apple stock. If he's lucky, this knowledge will pay off and he will make money. If he is unlucky and the rumor proves wrong, he stands to lose a lot. In contrast, intelligent investors focus on pricing. These investors buy a stock only when its price is less than its intrinsic value. Don't fall into the trap of only looking at short-term income. Instead, examine the company's financial history and look at the big picture. This step will give you a good idea of how well the company works independently its market value. For example, a company that is currently unpopular and therefore has a low share price, but it shows a promising record, an example has always earned consistent profits, may be underestimated, and what does make a prudent investment. Second, intelligent investors protect themselves from big losses by diversifying their investments. Never put all your money in one stock, no matter how promising it looks. Imagine how horrible it would feel if the promising company that you poured all your investments into shows up in the news for a tax fraud scandal. Your investment will lose value immediately, and all the time and money will be lost forever. Diversifying ensures you don't lose everything at once and remove you from the emotional stress of investing with the markets. You should always stick to a strict formula when investing. Graham calls it formula investing, but it is more commonly known as dollar cost average. That means you just set a specific budget that you invest in each month or quarterly. Then put that into the stock you picked up earlier, no matter the price. Third, intelligent investors realize they won't attract extraordinary returns, but a secure and stable income. The goal of an intelligent investor is to meet his own needs, not to outperform the professional stock traders on Wall Street. We cannot and should not aim to do better than those who trade for a living. Chasing dollar signs only makes us greedy and careless. Whether you're just starting out or have invested temporarily or full-time, you want to follow the path of the intelligent investors. You may not be a billionaire in a week, but I promise you too can turn your investments into modest but steady profits. Thanks for tuning in. If you enjoyed this video, make sure to subscribe to my channel and turn on notifications. Stay connected for more exciting content coming your way. Let's stay together on this journey of learning and growth. Hit the like and subscribe button now. Thanks for watching, and I'll see you in the next time.